Right, so welcome. This is going to be kind of the welcome basics and what we're sort of looking at. So there are some terms in here and things you'll want to remember, but it's basically again the gist of what we're doing and sort of what we're trading as well. So let's get into it. So trading profitably will take time. This isn't a get rich quick scheme, all right? So you'll learn lots of different things, many different things from many different people. You'll jump strategies and you'll most likely lose money, all right, at the start. Once you learn it and you stick to a strong, robustly tested strategy, you can become profitable long term. So everything you learn in this industry is part of a massive cognitive machine. None of it works independently. There's many factors like fundamentals, price action, psychology, market structure. I could go on. So everything happens and you can be the best at seeing how shit reacts, but there's also a psychological aspect to it which can also be a big factor, alright? So it's not only knowing what to do, but it's knowing how to react when things happen in front of you. So everything you learn is used as a knowledge base, and the more you practice and learn, the easier it will become. There's no way to fast forward this process, so it will take time. Over the time, you'll start to recognize patterns and pair prior knowledge together to help you formulate a decision. With that being said, take some notes. So, yep, I'm not offering financial advice. This is simply for entertainment value, and you probably will lose money. So take what I say with a grain of salt, because it is not easy. This is probably one of the hardest jobs you can possibly do, and it's the most straining mentally jobs you can do. You're risking your own money and you're risking it on an instrument that moves randomly. Alright? So it's not a get rich quick scheme, and 90% of traders lose 90% of their initial investment in 90 days. Be warned. Trading is not easy. Factors affect a person's psychology, and it can cause you to make stupid decisions. And when there's money involved and it's your money you've worked hard for, it can stress you out and you can do silly shit. So you might have seen these signal providers online saying you're going to get rich and you can retire and live in Bali, but you're not going to do it with a $500 trading account, are you? You're going to have to fucking have minimum at least 50,000, in my opinion, and you have to be a good trader with that 50k to even consider retiring. Obviously, the more money you have, the less you can risk, and so you're not going to get rich quick, especially with a small account. If you're risking even 50% of your account, a $500 account, so you're risking $250, and you make a trade, you make $1,000, cool. You're going to have to risk it 50% again, and you're probably going to lose the next trade because it's random. So you need a lot of money for you to be able to risk enough to make enough. Everything is in percents. Right. So this is kind of putting it into perspective. So we have indices like the S&P or the ASX 200, NASDAQ, all that, which are long-term uptrends. All right. On an average yearly return with the S&P, for this example, it's done an average of 10.13% per year. So that's pretty good returns if you just put your money in that every year. 10% with inflation, it really drops to 6.3. So to keep it easy for you guys, if you have a $500 investment and you're making 6.37%, you're only going to make $31 per year. Now, if you had a $10,000 account and you made 6.37%, you're going to be making $637 a year. Okay, now with a $100,000 account, you might be able to afford a holiday for the year. Obviously, now 6.37% is if you just put it in an indice. So this is the sort of trading where people, every week, they put a certain amount of their paycheck in these indices, and when they're, 70 years old, they're like, yes, I made $2 million, sick. 6.37% a year. This would be more investing than trading. All right, there's ways you can make more, but you need to know what you're doing. So you need money to make money, and you'll not get rich quick. However, if you get 4 to 5% a month, it's doable depending on the size account you have, and you can also grow it over time. Alright, so this is actually what we're trading. So what we're trading is the Forex market, so foreign exchange, different currencies. So Forex, short for foreign exchange, is the global marketplace for trading currencies. It involves buying one currency while simultaneously selling another. Traders speculate on currency price movements to make a profit. For example, if you think the euro will strengthen against the US dollar, you might buy Euro USD. If the euro's value increases, you can sell it for a profit. So the Forex market operates 24 hours a day, 5 days a week, Monday to Friday. Depending where you live, for me it's Monday to Saturday morning. Depending on where you live, there's 3 different sessions. So there's Tokyo session, London session, and New York session. Each of those sessions have movements that move certain markets. So in the New York session, you'll have movement on the US dollar mainly. It'll obviously be moving all the time, but mainly you'll get nice moves in the US dollar. For the Tokyo session, you might have moves on the Japanese yen, JPY, or even the Australian dollar or New Zealand dollar. And the London session will obviously be like Swiss franc, euro, Great British pound. So I'll just quickly go through this and show you guys. So this is the NASDAQ. So this is the top 100 shares of America. And so since we're in America, what session do you think will have the most movement in? Obviously, New York. So as you can see, at New York Open, we have big moves. So the red boxes is what we're looking for, and we have big moves during these red boxes. Now, if I go to the FTSE, so the UK 100, the top 100 shares of England, you can see that we have big moves in the purple boxes. That's because that's London session. And again, Tokyo session being slow. So these sessions are important for knowing sort of when to trade. And there's also the currencies that correlate with it. So keep that in mind. So what else we're going to cover in this is you can long and short, that's supposed to say, the currency pairs and leverage, and we'll have a look at pips as well. Alright, so you may have done a Forex trade before and you didn't even know it. So, for example, maybe you're on holidays and you go to England. At the airport, you go to a currency swap vendor and you swap your Australian dollars for British pounds. There you go, you've just done your trade. You've done a physical trade of 2 currencies. Obviously, the currencies are changing all the time. So maybe if you go to England in January and you give them 100 Australian dollars, you're going to get 50 pounds. If you go a month later, you might get 52 pounds. So it's kind of, that is a pretty big example, but the prices change all the time. So banks and institutions such as hedge funds, retirement funds, stockbrokers, they're constantly trading these markets. These are the markets they trade because billions of dollars go through it every day. And I'm pretty sure I'll cover that later. So this isn't just Australian shares like the ASX. If you trade in the ASX, you're only trading against Australians pretty much. This Forex is the global market. Everyone in the world is trading it. Every bank is trading it. All the countries put together. So it'd actually be trillions and trillions of dollars going through it every day. So you as a retail trader, someone sitting at home on your computer, whatever you put into this market, it is not going to affect it whatsoever because you have such small money compared to all these banks in the world. Banks, hedge funds, retirement funds, Australian super, all that stuff, they're all trading it, right? And they trade it in a specific way, which I'm going to show later on in this course. So in order to trade, you need to sign up with a broker. So there's lots of brokers out there, but it is important that you go with a reliable broker, alright? So reliable brokers is if they go under, your money is safe. So you need to do your research and find a reliable broker. For my style of trading, which I do, I need a broker that offers 1 to 500 leverage. It sounds a lot, but you'll see later why we need it. They also have different spreads, which I'll cover later. And yes, they have to be regulated. So if they go bankrupt for any reason, your money is secure. I use Blackbull. I'll put a link below. I'm not affiliated with them, but that's just what I use. They're in New Zealand, so they're good to me. And yeah. So the broker is your friend, but your enemy in a way. Now let me explain. A broker is your friend because they give you access to the financial markets. When you click buy or sell, they're the ones putting your order in the market. You need a broker to trade. A broker makes a commission every time you trade. They also make money with swaps. So they also get charged swaps, but they add on a little bit of swap commission onto theirs. They're a bit cheeky. We'll get into swaps later. The broker doesn't really want you to make money, alright? Because if you make a shit ton of money through their brokerage, they're the ones that has to pay you. Now, I don't want to get too deep into it, but there's A class people that are signed up and then B class. So if you keep constantly losing money, which most people do, they'll put you in the B section and they will not even put your orders through. So their orders will just be bent against their money. So you're pretty much betting against your broker if you're in that category. Once you start making money, they'll put you in the A category and you'll start actually putting money into the market. So you bet against your broker if you're in the B. Brokers are known to do sketchy things. So this is about spread again. If you have a stop loss or a take profit, they can spread it. They also spread the price at when there's like sort of news around. I don't really trade news, but they do spread the price differently at different times to maybe hit your stop loss or just miss your take profit. So that's just a warning for brokers, but if you find a good one, then you're probably sweet. This is just a warning about scammers. So these guys are everywhere. You see them all over Instagram, YouTube, wherever. This is probably one of the worst industries in the world for scammers, right? Because they prey on people that do not know what they're doing. They're just trying to take advantage of you for being naive. So it's hard to tell which is the worst scam, but the free trading signal groups are pretty bad. They're pretty up there. So these guys do not have your best interest in mind. They just want you to sign up. So you'll see them on Instagram standing in front of a Lamborghini and they're like, oh, I made this money trading. If you want to trade, you just got to copy my trades. And then you're like, all right, sure, I'll sign up. You sign up and they're like, all right, you have to deposit $500 because this is what their broker says. When someone signs up and deposits $500, you get a $200 commission. Anyways, so they just market and they get 50,000 people to sign up. All those 50,000 people lose their money. I can guarantee you. Everyone loses their money in these free signal trading groups. But these guys, again, their commissions from them signing up. So their broker's paying them, which is paying for their lifestyle. So be careful of people offering you a strategy that does not work long term, which is most of these fuckwits. They do not know what they're doing. You need to find a good mentor that knows what he's doing and trades like the banks, which is where all the big money is and where the money moves. It's hard to avoid these people and they are everywhere. Now there's a few others I can get into, like prop firms and having backdoor access to brokerages where you can absolutely just fake your profits just to sell a course. So there's the course sellers as well in that, but let's just carry on. Okay, let's look at the basics now. So we're trading currency pairs, different currencies against each other. There are 28 main currency pairs. They are simply exchange rates read from left to right. So for this example here, we have USD/JPY. It's the US dollar versus the Japanese yen. So we read it from left to right. So $1 is 144.17 Japanese yen at the time of recording this video. So it's probably different right now. As you can see, as of today, it changes all the time. Every day it changes. So yep, since you've read it from left to right, this has been equivalent one of the currencies. So $1 is 144 yen. If you long this pair, you're anticipating that the US dollar will become stronger against the yen. However, by doing this, you're simultaneously shorting the yen. Remember this when it comes to risk management, so I'll cover this later. And it's very important when it comes to dollar cost averaging trading and not being in too many pairs at once. So here's another example here, Australian dollar / US dollar. So you read it left to right. 1 Australian dollar is 0.6874 US dollars. At the time of recording this, it's probably different now. In Forex trading, currency pairs represent the value of one currency relative to another. A currency pair consists of two currencies. The first one is called the base currency and the second one is the quote currency. So left to right. This isn't too important, but it's good to know what you're actually trading and what you're actually doing. And a lot of these gurus online don't even know this basic shit. So as you can see, there's a few pairs here I've put on the list. Their price and their change over 24 hours. So these are the main currencies that we trade. And I'll tell you later why these are the main currencies we trade. So we have the US dollar, Great British pound, euro, Canadian dollar. I've highlighted the Swiss franc and the Japanese yen as safe haven because if there's ever a war or an oil line blows up or something like that, these two currencies are the currencies where banks will liquidate their assets in either of these other currencies and chuck them into Swiss franc or Japanese yen. This is because they have low interest rates. So if they put them in these currencies, they will just make money by holding it. If they just leave their money there, it's going to make them money. And this is another thing from what I was talking about before, where some currencies are similar in how they move. So when you're dollar cost averaging trading, you don't want to be in too many currencies at once because the Australian dollar and the New Zealand dollar move pretty similar to each other. Same with the US dollar and the Canadian dollar. So if you're in heaps of crosses of these pairs, you can get in trouble if you're stuck in positions. So here's the safe haven currencies. I've already explained that. We'll get into it later why. So there's also exotic pairs out there which we do not trade. So this would be like the South African rand, the Singapore dollar, or the Thai baht. So the reason why we don't trade these is because there's not enough money going through them for there to be clear market structure, first of all. And second of all, your broker probably doesn't have them, first of all. And secondly, if they do, they'll spread you. They'll give you terrible spreads for trading these pairs. And also most of the time they're pegged to another major currency anyways. So the Norwegian kroner won't have enough money going through it, so it'll be pegged to the euro. So you might as well just trade euro then. You'll get better spread, less commission, and clearer market structure. So now we have swaps and commission. So whenever you place a trade with your broker, they'll earn a little commission for allowing you to use their platform. This commission is based on the size of the position you placed in the market. So if you're not using too big of a position, you're probably going to get charged maybe 12 cents. Depending on which broker you're at, which currency you're trading, and obviously what size you have. So if you have a huge size, if you have a massive size on, commissions can get pretty expensive. So there's another fee in Forex which you kind of need to know, and it's important as well later on when I show you my strategy. So we have swaps. So swaps represent the interest rate differential between currencies in a pair. This will cost you money on some pairs, but also make you money on others. So here we go, positive swap. This is what the Japanese yen and the Swiss franc have. So if you hold this currency that has a higher interest rate, you'll just make money just for holding it. Just for having that trade open, you'll get paid every night. So it gets charged to you overnight. So just if you hold those, you'll be getting paid. However, some currencies have negative swap and they're all different. So it's the interest rate differentials that change every day. And these are also constantly changing. And they get charged for you overnight. So now there's a new concept which, if you have been trading shares, you probably just used to buying, and you're probably not used to leverage because you're using your own money. But if it's all new to you and you haven't really dabbled in the stock market, you can also short pairs. So we'll get into that. So you can go long or short on pairs as well. So what does this mean? So you can make money even if price goes down. So you can short a currency pair, you're shorting the base currency, and you're going long on the quote. So say USD JPY, you go short on it. So the base currency is US dollar and the quote is Japanese yen. So by shorting the US dollar, you're actually going long on the Japanese yen. So you just got to kind of get used to it. So shorting in Forex works similarly to shorting stocks when you're betting on a decline in value. Just remember that Forex trading involves risks, especially with leverage. So it is important to manage your risk carefully. Forex trading often involves leverage, which allows you to control a large position with a relatively small amount of capital, so your own money. This amplifies your potential for gains and losses. So a broker can offer you 1 to 30 leverage, which most of them do, or 1 to 50. So if you got 1 to 30, every dollar you put in is equivalent to $30, so 1 to 30. I use 1 to 500, so $1 is worth $500. So I'm pretty much multiplying my money, which can multiply my wins, but also my losses. So this is where it can get dangerous. This is where you see those hashtag Wall Street bet viral videos from people over leveraging the fuck out of their account and losing their life savings in minutes. So you're just not going to be a fuckwit, and you can use it to your advantage. So you obviously can't just enter massive fucking positions in the market and gamble your life savings away, because you require margin. So you need a small portion of the total trade value. So this is your margin. This is your money that you've put in. Once the trade is open, you need to maintain a certain level of margin to keep your position active. So if it goes against you and your account balance falls below this level due to being in drawdown, you might receive a margin call. So a margin call is pretty much your account is blown. You just lost all your money. So that's what a margin call is. So you want to avoid these at all costs. So don't over leverage. That is just, it's the stupidest thing, and you can search it up on YouTube and you can find so many videos of people doing this. So I'm just going to say it again, trading is not a get rich quick scheme. Successful / profitable traders can lose 50% of their trades and still be overall in net profit. So let's see how they do it. We'll show you later. So this is spreads, and spreads can vary from broker to broker. So this is what I was talking about before, where you can see over here, this is where price is, the top of this green candle. But if you were to order a trade, put a trade in, this is where your order will be filled, all the way up here. So you have all this movement. So as soon as you enter this trade, you're going to be in a slight loss. So depending on what broker you have, some have tighter spreads, some will spread you out and you can hit your stop loss or just miss your take profit. So finding a good broker that gives you good spreads is important. So spread is the difference between the buying price, the ask, and the selling price, the bid. So this is where price actually is in the market right now, but this is where they'll fill your order. So you can spot this easily on your MetaTrader 4. And you can also view the broker spread by looking at the Market Watch tab. It can be found on the right column. So as you can see over here, here's all the currencies we have. Here's the bid price and the ask price, and then on the right tab you have the difference in pips. So if you middle mouse button click and drag, you can see that on MetaTrader 4. Alright, so this next video is going to be a really good example of spread. So you're going to see that price is going to literally cover my take profit, which is this bottom line. It's going to cover it, it's going to be over it, but it's not going to close out because of spread. So spread's a few pips above. So just watch my reaction. Really close to TP now, and I said, and oh, you fucking serious? Just hit that shit. On the 1 minute. Where's my fucking take profit? Hit it! There. What the fuck? Oh, it's a spread. Boy! Alright. What does this mean for you? The second you place a trade, you'll be in drawdown. This is because you're entering the market at a worse price than what the current market value is. So this is going back to this previous example where you see the price has to tick slightly lower than the actual market price for the position to close out, for you to take the profit. And so it can work for you but also against you, because if price comes very close to your stop loss but it doesn't actually hit it, if you've got that slight spread or that slight distance in the candlestick, this slight distance from the actual price to the spread, it can stop you out. So if price comes and almost hits your stop loss and then reverses, but it doesn't actually hit it, if you've got that spread, that slight gap, it can hit it and close you out. This is another reason why I don't trade using a stop loss. And that sounds crazy, but you will see later on in this free course why they are completely useless and why you don't need them. How do we measure success as a trader? People always talk about pips. Do not waste your time learning about pips. They are fucking useless. Alright? That is just like, it's going to take you a few hours to learn what the fuck it is, and it's going to be no help to you whatsoever. And I'll show you why. So pips are useless. Pips are different on every single currency pair that you trade. Literally every single currency pair. So I'll just draw out a little example so you can see. So we have 30,000 pips, 0.4600, and then we have micro lots, so 0.1. So these numbers pretty much here, this is what pips are, and I'm just showing you what they are, so forget about it because you're never going to need to know it again. So forget pips and concentrate on actual growth. Pips measure how much the price changes in a currency pair, but the value of the pip varies between pairs. So maybe if you were trading one pair, which I've never met someone to do that. If you're just trading gold, then maybe, yes, pips can be valuable. But if you trade in different pairs, what the fuck's the point of them if they're all different? So instead of calculating the value of 0.001% of a dollar per pip each time you enter a trade, it's more effective to focus on the percentage growth of your account. This approach is consistent across all pairs, indices, and commodities that you're trading. So no matter what you're trading, if you make 20%, you make 20%. Across all of them, it doesn't matter. Targeting 50 pips on GBP NZD and 50 on Euro Great British Pound is completely different. The average daily range on those two pairs at the moment is 140 pips and 30 pips. So let's just imagine it's the end of the week or month and you're trying to measure how many pips you made on your account. Cool, I just made 350 pips. But what does that mean for you? You can't use pips for targeting price either, as they vary depending on the pair. So next time you see someone online in a signals group promising 500 pips a week, just run a mile, okay? I can make 500 pips in a day, no problem. I'll just trade USD ZAR, so US dollar versus the South African rand. It's got an ADR of 2,000 pips. That trade will be done in an hour. So if I took that trade and took a buy, I can make 2,000 pips in a day. And then I also make 50 pips on GBP NZD. So I've made 1,500 pips. Sorry, 1,050 pips. Sick, what does that mean at the end of the week? Using percentage growth targets has big advantages. So yeah, it never changes and it's consistent across every pair/instrument you trade. 1% growth on GBP NZD is 1% growth on Euro Great British Pound. It's consistent when your account grows. From say 5k to 10k, you are still targeting the same growth. So yeah, if you got a 5k account and you make 20%, it's the same where if you have a 10k account you make 20%. It's just percents. Percents are the same all the time, no matter what size account you have. It allows you to measure performance on the daily/weekly or monthly. In the same way, you can compare performance of this month and last year very easily. There's no calculating with pips, it's just percents. You can set a simple target of daily/weekly/monthly percentage growth to achieve your financial goals. So you might want to make 10% a month, and that's doable if you know what you're doing. So 10% a month across all pairs is 10% across all pairs. So here you go, I'll just draw an example. These are the pips, and they're different on every single pair. This is the spread. So you can see USD ZAR 16,200. Germ 30, that's the indices. So I'll do, say, NZD USD 150. Look at the difference. They're all different. Not one of them is the same. So just use percentages. It's more simple as well. And like, it's just, I'm baffled that people still use it or even like teach it. But anyways, that's enough of my rant. Just use percentages. Much of what you find online, particularly on YouTube and Instagram to be fair, is just noise, filling your mind with unnecessary information. This is why 90% of people fail in trading. The countless opinions and voices can be overwhelming, often leading to confusion, making you system hop. System hopping is one of the most detrimental habits a trader can develop. So you go to a system and you lose. So you're like, fuck it, I want to hop to a different one. You go to that one, it's working for a couple of weeks, and then it loses and you go, fuck, I'll hop to another one. So it's like a vicious cycle, and you're hearing and seeing all these people on YouTube teaching you different things, most of the time without your best interest in mind, just wanting you to buy their prop firm or sign up with their brokerage. This is why the Forex industry has such a bad name. So honestly, you just got to avoid all the noise and find one good mentor. If you have one good mentor, you're sweet. I learned from someone that has been trading from in the markets since the 90s. And that's why I know what I know and how I trade. So once you've robustly tested a strategy and confirmed it's profitable over an 8-year period, so you need to backtest this in MetaTrader, you need to backtest it robustly. And once you know that you have a long-term edge over the market, so you might have some losing months, but overall on the long term, after a big test, if you're profitable, you got less to worry about. And why would you even systems hop if you've got something that works long term? So you could start a strategy and lose for the first month, but you know from back testing and forward testing that it's got a long-term edge. Why would you even change from that strategy if it's just going to work? If you know it's got a long-term edge, you can stress way less because you know long-term you've got an edge. Like casinos. Casinos have a long-term edge. So they might give one person a big payout, a big win, but from all the other losses, they're making it back. They have like a 1% edge. It's let me explain it like this. Roulette, it has red and black, but it also has the one green tab, the 0, all right? So if it were red and black, it'd be 50-50, but you have that one green that puts it slightly off, so it's not quite 50-50. So if you were to play roulette your whole life, you would end up losing because long term it's not 50-50. You know what I mean? That's my best way of explaining it. Let's carry on. There are 3 strategies you can trade, and that is it. So you can do trend trading, which I don't like. So it involves identifying and trading in the direction of a prevailing market trend. I don't like it because by the time you identify a trend, it's probably too late and it's going to reverse. Secondly, we have mean reversion, which is sort of my bread and butter, and it's how the banks and institutions pretty much trade. So we dollar cost average in, and we're expecting price to come back to its mean once it's stretched very far in one direction. So it's going to come back to its historical average. We'll get into that more later. We also have breakout trading. This is really good. I also trade this as well, and I trade this with prop firms. So breakout trading focuses on identifying key support and resistance levels, usually on a small time frame. And once price breaks out of that range, it's going to run to the next level of support or resistance. So it's very good at New York or London Open trading the correlating indices. For for those, because you're going to have a breakout and you're going to run to the next level. But I can show you that in another video. This is the basics. I don't want to go on for too long. Let's carry on. There are 5 targets for price. That's it. We make money when we leave the market, not when we enter. So we can have measured moves using Fibonacci retracements. We can use risk reward or target an average daily range. We also have levels like support resistance or propulsion gaps. We can get into that later. These words are probably all new to you. We have trailing stops, timed exits, end of day exits. Those are the 5 exits you can have for take profits or stop losses. All right, so probably write this down because we'll get into this later and it's quite important. To simplify trading, there is no way of knowing where the price is headed. All you can do is press buy or sell and manage a position once you're in. If a central bank decides to put $20 billion in the Swiss franc, they will, and the Swiss franc will skyrocket. If you're in shorts, you're going to be in trouble. But there is no way of knowing that we're going to do it that day. So this is why you got to enter small and average. Keep your price close, your average price close. So when big moves like that happens, you're not going to blow your account. We'll get into that later. This is just lesson 1. I'm getting ahead of myself. So trading is not an easy job. You're trying to extract money from an instrument that moves at random, using historical analysis on data that is never going to repeat itself again. Not one day, you can go back any currency pair, not one day has price moved the exact same. So this is important to know. Once you know that price is random, that's when you'll start to see yourself making money. We'll get into that later as well. So it's important to understand that price can only do 3 things. It can either go up or down. It can consolidate, and that's it. I'm not going to overcomplicate it. So price can keep going up, higher highs, higher lows. It can go down, lower highs, lower lows. Or it can consolidate, which is pretty much just sitting in a range and it's not going anywhere. These are the terms you'll hear. Long is the same as buys, bullish and bulls. So this is price going up. I've highlighted it green, and then red we have short, sell, bearish, bears for shorts. So price going down. We have support and demand, which are pretty much the same things. There are slight differences which I've got shown in another lesson. And then we also have resistance and supply. So probably search these terms up because I'm not going to explain them all. It's going to take too long. Search these terms up and just see what they are. So remember, there are a lot of terms you'll hear throughout this course. By the end of it, you'll have an understanding of most of them, hopefully. So this is the end of the lesson, and this is what we've learnt. So what it is, what we're actually trading, and that it's not that complicated. There are people out there that try and make it complicated and add all these random indicators and strategies, which will just confuse the fuck out of you. And we've also gone through some simple terms and what it is we're trading, shorting, and leverage. So I hope you liked it, and this is just lesson 1. So we've got heaps more lessons coming out for completely free. So look out for it, and got some good content coming. Cheers.